everyone. Welcome to the Trading Market Technicals morning call video for Tuesday, February the 5th. We had a down day yesterday. Dow ended up closing down 129, Nasdaq down 47, S&P down 17. Dollar ended up ticking up on the day, up 28 cents, and gold up 2.5. Outside day reversal confirmed. And what does that mean? Well, Friday we had an up day. Monday, yesterday, we ended up taking all of its gains back and closing lower on the day, taking out Friday's lows. So what does that tell us? That means that we do have some volatility picking up, and when volatility usually picks up at tops and or bottoms, you usually will have a directional change. Now, obviously, we don't want to be picking tops, and one day doesn't make a trend, but I do feel that we are in a process of ready for probably a 3 or 4% correction. And even then, if we do get a 3-4% correction, the markets will still remain in a bullish uptrend. So just please keep that in mind. What I'm looking at here and what I've been seeing in the charts is that maybe markets actually pop up sometime today, rally, and then create another right side of a shoulder, of a head and shoulders pattern, and then start to sell off. So this is something that I'm going to show you on the charts. Prior to that, don't have too many indicators. They're all overbought, still the same. Again, one day does not make a trend, but we need to be cognizant of what's happening here. And we don't want to be taking an extreme amount of risks right now, but when the markets start to roll over and we get a confirmed sell signal, that's when we can really start getting a little aggressive on the short side. Now, on the economic data front, we have, if you look at the board here, we have ISM services at 10 o'clock, pretty much light throughout the week. So technicals are going to really come into play here. And of course, if there's any news like yesterday, what happened with Spain, markets end up selling off. Now in the pre-market, we're up about 5 handles in the pre-market. So it looks like bottom feeders are starting to come in and look to try to buy these dips. And what usually happens in this bullish sentiment, you buy the dip until you get burned, right? So every time somebody keeps buying a dip, what happens is that you're buying the dip at these lofty levels, and when the market does turn around, the markets actually start selling off much faster than what a usual, just a small pullback or on light volume. So you really want to watch what happens here and keep in mind that the markets are at these extreme levels without any sort of pullback. And anything comes out to spook the markets is only going to be one door and one exit. So again, keep that in mind. Longer term picture still remains intact. Again, we had an outside day reversal. We need a confirmation for today, and let's see what happens if the markets can put together a couple-day losing streak, and then maybe we might have something here. But we are up in the pre-market, so it'd be interesting to see if these gains are going to be sustainable at the opening this morning at 9:30. All right, so let's take a look at I want to show you the NYMO, and I'm going to show you just 2 indicators. We're down 21 here in NYMO, so we got plenty of room to get oversold here, right? So if the markets want to really just continue to sell off, we're not even in an oversold territory. So we got a long way to go before we even start hitting 70, 80, or 90, negative 70, 80, or 90. So again, just an indicator. Price is what pays us, but I just want to show you warning signs here. And this one here, the NASDAQ record high percentage index, we were up at 100 the whole month of January. We're just starting to tick a little lower. So we had this one little pullback here. Usually, and I would kind of showed you this for the last couple of months, that we have usually when we first pull back, 2-3 weeks later, we pull back again and then we rally. So this could be the second pullback off of this at the end of December. But we'll see. Let's take it one step at a time. Now, we see the volatility index starting to pick up again. And when I mentioned earlier that when you have volatility start to pick up at these areas, at these market possible tops, possible now, you usually have, that's a sign of saying that we have a little indecision. One day we have market up, next day the market down. So what happened? The bulls and bears are fighting to try to push this market higher, where the bears are trying to push the market lower. Hence the volatility. People start buying protection because they're getting a little bit nervous, and that's what happens. Exactly what's happening here. Now, one thing we want to look at is the dollar, and we definitely want to keep an eye on this dollar. And I keep mentioning it. We have this head and shoulders pattern on a daily and on a weekly chart, but it has not triggered. This is the neckline here at 79. We have a big nice big candle, an engulfing candle that took out 3-4 days of down days last week, and now we're coming into this confluence area of resistance, 79.5, 80. If you take this out, I think you're going to have a good run back to the 200-day moving average, and if that does happen, that should help us with a little bit of a sell-off. And again, a correction is actually good and healthy for the markets. You can't go straight up without some sort of a good pullback, or at least maybe a 1 month consolidation, 3 weeks. We had nothing but up days the whole month of January. So this is something that we're going to be watching. So the dollar is going to definitely play a key role here on what's happening now. What I want to show you is let's take a look at the sentiment. I said, watch the sentiment. Junk bonds, ETF, JNK, high yielding junk bonds. Look what's happening. Risk is coming off the last 4 days. While the markets have rallied on Friday, look what happened on Friday here in the junk bond JNK. Actually did nothing. So this is interesting. Also, I mentioned the healthcare sector, the XLF, the XLV, the utilities. Consumer staples, money's flowing into them the whole month of January. So that is something interesting, that an interesting development. Again, nothing actionable, but you have to look at the big picture, and I look at it every night to see, all right, risk is still on. However, we have some red signals, and that's why I am not aggressive. I haven't been aggressive this whole month of January, and of course the last couple of days, only to be ready when the market does turn around. Taking a few day trades, taking some small stops, it's not a problem. It's part of the game. However, you want to be ready and nimble, that when the markets do react, you're fresh and ready to react, and that's where the gains are going to come. So just kind of take that note. I've gotten emails, and I get it quite frequently. Oh, I'm getting chopped up. What do you think? The problem is that when in doubt, cash is a position. That's the bottom line. And if nothing is clear and you don't see the best trade setup, if you're trading during the day, then just stay off to the sidelines a little bit. I know everybody needs to make money, but the profits will come. You just have to manage it accordingly, to what the market has given you, or obviously the trader. Okay, so we have risk coming off, and we have volatility picking up at these lofty levels, and that's interesting. So we want to really keep an eye on what's happening here. At any given day, you can have a market kind of roll over and start to sell off here, and you want to be ready for that. All right, here's the S&P overlay with the average true range, and I've showed this charts many times before. As you can see, when volatility starts to come in, we have the markets go up. We have a flat line here. We're flat here. Markets actually, average true range start to pick up. Again, volatility. Markets start to roll back down again. And look at what happened here. We had markets actually roll up, and we have volatility now come in, which is the average true range, showing you that there's no volatility when the market's just grinding higher, obviously. So now we're at this support line again, and we're starting to hook up again. So this is going to be interesting to see what's happened. So this is one you want to pay attention to, the average true range of the S&P. If we start to tick up again, that's going to be definitely a red signal to say, a red flag to say, hey, heads up. Let's use caution here. If you're swing trading, you might want to tighten your stops, trail your stops. Long-term trader, you might not want to buy anything at this moment, because you're going to probably end up buying something a little cheaper down the road. Okay? Take a look at the spiders. Outside day reversal. We took back Friday's. Not only did we take back Friday's gain, we closed much lower and below our uptrend channel. Heavy volume, distribution day, as you can see here, and our indicators are starting to roll over here. So this is something that that is saying us, okay, one day does not make a trend, but we need to be cognizant of what's happening here. We do have an outside day reversal bar. Usually get some follow through. Now this morning, again, we're still up here, so we could actually take it right back again. And again, that's that volatility. We could be up one day, down the next, up the next, and then the market finally breaks. But this here, that 149.32 I mentioned yesterday, that was Thursday's low. We need to take that low out. Thursday's low, 149.32 on a closing basis. That would kind of really get me more serious about saying, okay, I'm going to start looking for shorts now on a closing basis. And the 60-minute chart will tell you the same thing on the spiders as well. We are at this level right now. And this is the level we're looking for, 149.32. I have this on here, the 60-minute chart. Watch this area here. Now, we are a little bit down in our stochastics. We're down below the 20 area. Our RSIs is right around the 40-ish, so we could get a little bit of bounce off this trend line here from earlier in January. Maybe come back up to the 150.49, maybe up $1 or so, and then start to break low. But that's going to be the area, 149.32 on the spiders. And same thing here. If you look at the cash, break down below, outside day reversal bar, close lower, and that is the area from today. Yesterday's low on the cash, if you're following the cash, is really going to be key for today. And that's what we're going to be watching for on a closing basis as well. Okay, and this is the S&P Cash 60-minute chart. As you can see here, our RSI and MACD is trending lower. And I had this up here on Thursday, and I showed you a bearish rising wedge. Took them out to the wedge, added that to this area here, and this is where we get. So this could be the possible pullback right around the 1465, 1470-ish area. Now we're still here. We didn't even get to the 23%, so we could easily just kind of back test this lower trend line. Maybe get up to that 1505-ish, 1508, which sounds more logical, and I'm going to show you on the next chart here. Now I had here a 30-minute S&P chart on Monday morning, and I said this could be a head and shoulder, possible head and shoulders pattern, and it was right up in this area here where the right shoulder was. If you see my my RS, my right shoulder. Well, I mentioned on Friday that was negated because it popped higher. Now what it looks like is this could possibly be the head and shoulders that we're looking for, right? With the right shoulder coming back up in this area, and that would be 1508. So the 60-minute chart kind of coincides. That's the lower trend line, the longer term lower trend line on the 60-minute chart comes in around 1508. So again, I have question marks as nobody knows. We could just break down from here, and then it's just nothing more than just, a couple of topping formation patterns here. But keep an eye on this. Maybe we rally today, and at the end of the day, they start to sell them off. So 1508 could be the right shoulder, and then we start to move lower from there. And then this would be really to break lower this way. So this is something that, again, has not happened yet, but I like to always look at what can be, in our analysis at the end of the night. So this possibly could be the head and shoulders pattern that we're looking for on the 30-minute chart. Obviously, neckline would still be the 1496. All right, now, transportation sector, our leader here. And as you can see, momentum is definitely waning. We're starting to break down in our stochastics in our MACD. We do have an outside day reversal as well, but we do have two dojis, indecision candles. And this is going to be the break still. 102.35 is going to be the break on a closing basis lower that would initiate a sell signal to the market, especially the transportation sector, which is a leader. Still remains the same from Thursday's low. Diamonds, again, outside day reversal. As you can see, repetitive patterns. We have it all in our 5 sectors that we follow, and we're just broke below it. And the diamonds here had a great run in January, and now it's ready and due for a pullback. I do see that the first area would be the 20-day moving average, maybe another bounce and then break down below to this area here. This is going to be a good buy-in at 134 in the diamonds, and that's the Dow Jones ETF. Same thing here, IWMs, another leader. As you can see here, our momentum indicators are starting to roll over. We do have an outside day reversal. Again, 5 sectors that we follow, all outside day reversals, close lower on the lower trend line. So just keep that in mind. One day does not make a trend, as you can see, but volatility is picking up at these areas, suggesting that there is further downside to come. Apple. I mentioned Apple yesterday. I said stay away from it. It's a trading stock right now. I do think it goes lower. It did not get back. Now, this is one day, obviously, the red candle. But I said yesterday, this green candle, we couldn't even get back above the longer-term trend line to take back 50% of this previous week's candle, which comes in at 474. That is a warning sign enough to me to say stay away from it unless you're just day trading the stock. If you're looking to buy into the stock, the first buy-in would probably be around 355, 360. And again, that depends on your long-term objective of the stock. If you're looking just for a bounce, that's one thing. If you're looking to average in and you're looking to say, hey, I don't care, I don't mind averaging 200 points to the downside, then, of course, position size yourself accordingly. But, again, weekly chart here looking not really too good. As you can see here, we closed lower on Friday, and we had some indecision candles here. The good part of last week, Friday couldn't even rally on a big update, and we just sold off again. So if you're looking to buy in, do not buy in here. As just a recommendation. Again, you have to do your own homework, but this is not the time. I think you're going to be able to buy it cheaper. I'd rather buy it, believe it or not, a break above 462, looking for a move to the 20-day, or buy it below this channel at 420. But nonetheless, I do think that the better buying will be the 200-week moving average. Okay, last is the Qs, again, being held hostage via Apple. So we're breaking back below this consolidation area. It's been in a real consolidation the whole month of January, but we do have good support in this 6580 area. So just keep an eye on it. Technology is looking a little weak too as well. So it'd be interesting to see what happens in the next couple of days. if we do get that pullback, or if the market wants to go higher, move higher. So keep an eye on your indicators. Watch those levels that we're looking for in the sectors here, and let's see if we can get some sort of a pullback that's actionable here. All right, guys, have a great day today, and we'll talk to you tomorrow.